We are. So we're at 101. Welcome, everyone. I know some people are still dialing in. Welcome to JF Capital Unplugged, number 6. The last one of these that we did was quite a number of months ago. We've been getting asked a lot of questions, and we thought it was a good time to do this, even though most people seem to be webinared out. We enjoy doing them. We are recording this, so if anyone drops off or joins partway through, the recording will be available sometime later today, but definitely within the next 24 hours. I know most of you, but for anyone that I don't, I'm Jonathan Falik with JF Capital Advisors. On with us, I don't know where he shows up on your screen. On my screen, he's on the left side, is Ellie Grodko, who's our superstar VP at JF Capital Advisors. I've worked with Ellie for many, many years. And what we do is strategic and capital markets advisory work, sponsor investing, all around hospitality and the hospitality industry. We work on full service hotels, limited service hotels, boutique hotels. If it looks like a hotel, feels like a hotel, sounds like a hotel, we might do something with it. We have an active asset management business. I think at last count, we were involved with 23 debt restructurings over the last almost 22 months. Some of those will need will need some additional help going forward. But here we are coming in, about to be in the second half of December, after a pretty crazy year. It wasn't quite as crazy as 2020, but we're certainly looking forward to 2022. We're going to do this in a bit of a Q&A format. So Ellie's going to first introduce himself, and then where he comes from and where he is, and then we're going to get right into some topics and some Q&A and have a free-form conversation. If anyone wants to ask a question along the way, some people have filtered questions in previously, just to hit it in the Q&A button on the bottom of the screen, and we'll try our best to get to it. We're planning to go for 90 minutes, and again, we understand if you need to drop off, this will be recorded and made available after the webinar. Ellie.
Okay, everyone. My name is Ellie Grodko. I am a vice president at JF Capital Advisors. I've had the privilege of working with Jonathan for, I mean, it's got to be around 8 or 9 years now, which is, a pretty material amount of time, at least in my life. And I'm honored to be here on my first JF Capital Unplugged co-hosting. I'm living in Los Angeles, California. I moved here because my wife wanted to move here, and I followed her here because her parents live here. And I'm actually expecting my first kid, so I'm very, very excited.
Excellent. We could use some intern support. Ellie, let's jump into it.
All right. So, Jonathan, let's first talk about industry challenges. Coming out of COVID, hotel performance has varied greatly depending on the market and the asset class. As a whole, what do you feel are the biggest industry challenges from an operational standpoint?
So operationally, the biggest, I know we'll talk about a little bit later on, is availability of labor. That is at all levels. That's at the managerial level, that's at the line level. So that is housekeepers, that's cooks, that's bussers, but it's also sales directors and accounting people. A lot of people have left the industry. So that's one big piece. Another big piece is forecasting. How do you do revenue management, and how do you forecast, and how do you create a pro forma and a P&L without understanding the underlying sources of demand and without having an environment, a market environment like we're in past cycles, right? So when you really drill down to it, everyone has gotten more sophisticated in the industry. We're using a lot of revenue management systems that rely on a lot of algorithms and a lot of data based on what's happened in the past to predict and project the future. We have not had a situation like this before. We've gone through prior down cycles. Many of the ones that we've lived through have come as a result of upside down credit markets or a major economic problem, not a major healthcare problem. So if you go back to 2008, 2009, you had this global credit crisis, and as a result, the economies were damaged, the US economy, global economies, and it took time to bounce back, but no one was looking up saying, I'm really concerned that if I go to this conference, I could get sick and I can get infected and I can die, or I can infect my family members or my friends. You go back to post 9/11, people were scared and didn't fly for some period of time, and then they started flying again. But that was on top of already some sort of economic slowdown and issues with the dot-com boom. So we have not had an environment where we had a major health crisis and a major health scare that really influenced what's going on. And quite the contrary, instead of there being kind of economic challenges, globally, there's been massive economic stimulus. And in the US alone, Ryan Melliker from Lark put a chart up on his webinar, I think it was last week, maybe it was 2 weeks ago, that showed about $7 trillion of stimulus that came into the economy or to come into the economy, plus a whole bunch of forbearance, right? So student loan forbearance, foreclosure moratoriums. So there's massive amounts of economic stimulus, the likes of which we've never seen before, and forecasting through that is pretty challenging. The other problem that's going on, and everyone's been reading about supply chain and inflation, and we'll talk about that a little more, but supply chain especially, if you're running a business and you can't get the basic goods or materials that you need, you're already struggling with labor, but you can't get the basic goods and materials you need to put in the rooms, or you can't get the steaks that you need for someone's wedding or for someone's corporate event, and you contracted for it, you start to have a problem. So there's a lot going on that is making day-to-day forecasting, management very, very difficult. And on top of that, we've just gone through probably the most chaotic period in the professional lives and personal lives of so many talented employees, both managerial and line level, at hotels all over, and many of them are just burnt out. Many of them are burnt out, and we're all cheerleading, saying, "Hey, things are coming back to normal," and they're tired. They're tired. They're dealing with family pressures. They are tired.
Right. Yeah, makes a lot of sense. Yeah. I mean, let me ask you a different question, kind of switching topics a little bit to labor, a topic that's likely on every hotel owner and operator's mind. How hard it is to find and to keep employees. Why do you think it's so challenging? And in your opinion, will the labor market get better? And if it doesn't get better, what are the solutions? I'd say, lastly, how does this environment been impacting union and organized labor?
So each one of those is like an hour or an hour and a half long webinar, but let's talk about it, right? So we have two major issues we have to deal with. The first is RevPAR, right? How do we figure out occupancy and ADR, and how do we actually fill the hotels? And then once we get through the rooms revenue, we're thinking about, okay, what about food and beverage revenue and other? But then all of that revenue needs to flow down to the bottom line. And with labor wage rates increasing substantially, and where there are unions, there are significant demands for reduction in housekeeping credits, better conditions, less hours, more pay. We end up with a big problem in terms of flow down to the bottom line, to GOP or to EBITDA. And we spend so much time talking about RevPAR, and the industry pundits and all the tracking firms project occupancy and ADR and RevPAR. Most of them don't project EBITDA. And
Right.
we were talking this over, Ellie, we were talking this over the other day with our intern who wanted to weigh in on it. So let's see what our intern has to say.
Hi, it's Ryan the intern. I know that some of you have been asking about me at the industry conferences, but I'm in 7th grade, so it will still take a few years before I can enjoy cocktails with you. I said this before and I'll say it again. All this focus on RevPAR and RevPAR recovery is great, but you cannot pay your debt service with RevPAR index.
So that's what Ryan, our intern, has to say. I think we're going to hear from him again in a couple of minutes, but you cannot pay your debt service with RevPAR index. So all this focus on top line is great, and you need top line to generate a bottom line. But Ellie, you started talking about labor. Labor is growing. Labor wage rates are growing. Benefit costs are growing substantially faster than we've seen before. And we think that's, at least I think that's unlikely to change.
Right. And keeping in the theme of inflation, and things going up. Obviously, as of November, inflation jumped almost 7% year over year, the fastest rate since, I believe, around 1982. What should hotel owners take away from this? Is it good for hotels? Is it bad for hotels? And lastly, what are your general feelings regarding the past and anticipated actions of the Federal Reserve?
So you like asking these like multi-part, 17-part questions. They would kick you out. I end up, as you know, I do a bunch of expert witness testimony, and there you get like one directed question. Someone starts asking a whole bunch. It's objection. So there's a lot of scholarly debate. There's a lot of industry debate. Is inflation good for hotels? And in some ways it's very good, and in some ways it's not so good. So let's dig into it a little bit. If your revenue and your ADR is resetting on a daily basis, because unlike other real estate asset classes where you might have a 10-year lease or even a 1-year multifamily apartment lease, hotel prices reset almost on a daily basis. Now, there are corporate contracted rates that might get set in for the quarter or for the year, but ADRs really reset. And as a result, if inflation kicks in and you can charge a higher rate and you can charge more for your banquet business, you could charge more for a steak or a hamburger in your restaurant or more for a cocktail in your bar, that's generally speaking a good thing. However, if the costs of labor and the costs of those goods inflate at a rate higher than your ADR or your RevPAR can inflate, it's bad. So one of the things that we're seeing right now is a huge increase in the cost of food products. So if you want to buy steaks, if you want to buy tomatoes, if you want to buy various fruit products, the costs are way up. The costs of labor are way up. And we're seeing an increase in the ability to raise average daily rates, mostly with leisure travel, and only in certain markets. But over a shorter to medium term time frame, the real question is, will the ability to have RevPAR grow outweigh the increase or the inflation of expenses? And the labor expense is generally the biggest expense that any hotel has, whether it's full service or limited service, between the managerial staff, the housekeeping staff, the kitchen or culinary staff, maintenance, security, et cetera, plus benefits on top of that. That's by far the biggest expense that you have. And if that's inflating, there's a problem. Now, there are all sorts, we're going to have to talk a little bit more about labor after this, because we didn't do it justice. But as a practical matter, if you can inflate your NOIs by having a higher revenue and have your revenue grow faster than expenses and have your NOI increase, and you have constant dollar denominated debt, right, that's generally a good thing. So you should be able to pay off your existing mortgage with future inflated NOI dollars and a future mortgage. Now, part of the question is, how long will the inflation last? Who does it hit? Will that impact people's propensity to spend in hotels if all of a sudden their dollars of savings are worth less and they're spending more money, whether it's on automobiles or on mortgage interest payments? So it cuts both ways, but historically, inflation has been a net positive for hotels. Here we have to be very mindful of the labor impact and the cost of all sorts of products, all the amenities and the food products that hotels need. And the last piece to it, and you didn't ask, but I'll just tease it out there, is the hotel industry is very capital intensive. And even though we all underwrite a 4% or a 5% FF&E reserve, the actual CapEx that hotels generally will spend over time for FF&E and other CapEx is generally north of 9% of revenue. And Ellie, you know this very well because you did the work. I take credit for it, but we did a 10-year survey of all the public hotel REITs and what they spent over a 10-year period. And then after 10 years, we updated it for another 10 years. Now we have a 20-year study where we see almost all of the public hotel REITs, if you eliminate acquisition CapEx, the spending that they've done for repair, for repairs, but things that are capitalized, is 9% of revenue. And we've gone through a period over the last couple of years where revenue has been depressed, right? But rooms still get used, facilities still get used. And we're going to get into a point in the next few years in the cycle where people have to do PIPs. They have to do brand related PIPs that were deferred, or it's coming up on the brand functional life cycle, or the property functional life cycle. And they're going to have to spend money in order to upgrade the hotels, to bring the hotels to brand standards. And they're going to have to do that in the middle of a recovery. So forecasting for both the industry and for markets and for individual properties, and then layering in, you're going to have to do a PIP, and you're going to have to renovate your meeting space, or you're going to have to renovate your guest rooms, and do that at a time when the supply chain is a little bit convoluted and upside down, and you're not sure if you can actually get the materials that you want delivered to you to do that PIP. And even if you can get the materials, can you get the labor when you need to do that PIP? So, we're in for kind of another few years where I think the health scare will be behind us, but the ability to forecast and the ability to plan and do project management effectively is going to be challenging. It's just going to be challenging. And same thing, we were talking before about labor within the hotel. If you want to do a PIP and you need to find a general contractor and they need to find subcontractors, or you're doing it yourself, where's that labor coming from? Right. You're competing with all sorts of other businesses, and you're going to be competing with the federal government, who's, infusing dollars into the economy for infrastructure or other projects. One of the things on the labor side, Ellie, one of the things that's happened is, we've lost a lot of people out of the industry. They figured out, if a pandemic can hit and we just fire them, either furlough or fire or sever them or terminate them, whatever the terminology is, on 2 days notice or on a week's notice, with, maybe severance, maybe minimal severance, maybe the hotel industry isn't so great for them. That's what a lot of people are thinking. And then they think about, well, what else can I do, right? Let's put aside all the stimulus and all the government incentives to not work, because some of those are wearing off, right? But let's assume people need to be gainfully employed. They have to have a job. Well, if they can go and work in an Amazon warehouse, right, or as an Amazon delivery person and make as much or more than they can in a hotel, and they don't have to worry about people coming and maybe infecting them. They don't, they can do what they want, or they can just drive a car for Uber or Lyft all day. Think about that. Now, Amazon has hired about 650,000 people this year. And they announced that their plans were to hire another 125,000 people in Q4 alone just to handle holiday deliveries. So, and then you turn around and you see some of the incentives that Uber and Lyft are providing for drivers, right? Some are full-time, some are part-time, in order to come on board, and some of them are making $30 an hour. Right. So how do we as a hotel industry compete with that? Like, we need to rethink our labor models. We need to rethink it in a way that works with the customers, right? Which may or may not make sense, right? We really need to get through it. And one of the things that, that everyone seized on during the pandemic was like, oh, we don't have to do daily housekeeping. Now, that's great for us because it means a lot less labor. And it just so happened that people didn't want us in the rooms. Some of that is coming back. Some of that is coming back in full service, not limited service. Some never went away with it. And I think Ryan, our intern, wanted to chat about that as well.
I don't really care that much about daily housekeeping, but I do find it critical that there is a really good burger at the restaurant or at the pool. And then it goes without saying, for someone who is pretty attached to my phone, laptop, and iPad, really great Wi-Fi is so important.
Thanks, Ryan. So as a practical matter, right, we've done this daily housekeeping forever and people have gotten used to it. They've become accustomed to it. I personally don't care about it. Now, if I'm on a leisure vacation, I might be a lot more interested. As a business traveler, I could care less. So if we can, in an intelligent way, without offending our customers, go to substantially less housekeeping and better staffing and better shifts, we can do that. One of the challenges that we're dealing with a lot of the hotels that we do asset management or advisory work for is for probably the first time in as long as I can recall, part of the revenue management decision making is focused on whether there's labor available to actually clean the rooms, whether we can get laundry done or delivered in time and housekeepers to actually clean the rooms and turn the rooms so that they're in service. And we're seeing a lot of properties and a lot of markets that are intentionally leaving rooms out of order so that they can better manage their housekeeping staff. And so they don't end up with too many arrivals, right, with rooms not available for them, which to me is like, it's very frustrating and kind of drives me insane. But that's where we are from a revenue management perspective today. And, customers, they expect if they make a booking, they get to show up. Right. They get to show up. They don't want to hear like, oh, your room's not ready or it won't be ready yet. And by the way, they with a lot more leisure travel over the last 18 months than business travel, many people are showing up much earlier in the day and don't have a meeting to go to. They want to drop their bags, charge their devices, go touring, go to the pool, go chill out, go do whatever.
Right. Yeah. You just mentioned, over the last 18 months, there's been a lot more leisure travel than business travel. Let's talk about a little bit the work from home trend and how it's impacted hotel performance. I think in late 2020, a lot of people believe that business travel would bounce back significantly in the second half of 2021, and that really hasn't happened. In your opinion, is business travel dead?
So it's interesting. There's clearly some business travel, but in 2020, when I got on planes, and I got on a bunch of planes, not as much as I did in 2019. Everyone was in a tracksuit. Everyone was, or jeans and a hoodie. There was no one in a tie. There was no one with a briefcase. It was a backpack, and it was clear. Now, some of those might have been business travelers dressed down for the travel experience, but in the main routes that I was flying to New York, to San Francisco, to Miami, to Dallas, coming out of New York, normally on the flights I was taking, I would have seen a lot of people that looked like they were getting off the plane and going straight to a meeting, or they just finished a day of meetings and they were flying on to the next city, and we didn't see that. Started to see a little bit of that pop back in earlier this year in April or May, but still the majority leisure travelers, not as many business travelers. And some of that was certain companies put a moratorium on business travel, and they said no one's traveling for a few reasons. Number one, it was a good money saver. Number two, and these are not necessarily in order, good money saver, right? Not having people spend money on hotels and airfares and wining and dining and all of that. Number two, preserve kind of the reputational, are you forcing your employees to go in an uncertain health environment? And number three, right, many employees didn't want to get on the road and go somewhere. And even if they went somewhere, were people in office buildings, right? So one of the issues we see right now, and we've been tracking it, is if you look at the major markets across the United States and look at the top 10 markets, the functional occupancy, the functional office occupancy is about 40%, meaning if 100 people would normally in 2019 be in an office building, 40 of them are now regularly, or 40 of them are regularly coming into that office building. You see the stats are lower than that. They're in the 20s and pushing 30% in Silicon Valley and in San Francisco. And you see them higher kind of in the high 40s, low 50s in Austin, Dallas, Houston, right? In cities that don't have the same states that don't have the same mask mandates and regulations and are a lot more open. Some of the southern states as well. So as a practical matter, why would I, as a business traveler, get on a plane and go fly to Silicon Valley to meet with an empty office full of people or an office devoid of people?
Right.
Why would I do that? The other piece to it is, with the availability of Zoom and all of the Zoom sort of equivalents, people have figured out that they can do a lot more work remotely and in some cases very efficiently. In some cases it's inefficient, but in some cases very efficiently. And that has allowed people to do a lot more leisure travel where they can, instead of jetting from New York down to Miami on Friday afternoon for a weekend and coming back Sunday evening, they can all of a sudden dial into their Monday morning department meetings, committee meetings, whatever it is, and at 11 o'clock log off and go back to the pool, go back to the beach. So we're seeing kind of this extension of the ability to take leisure travel and leisure weekends, where Sunday nights used to be the worst night of the week. In leisure destination markets, right, where there are beaches and pools and fun activities, Sunday night is no longer the worst night. Or if it is, it's gotten way better than it was before. And similarly, a lot of people are starting their weekend travel on Thursday instead of on Friday. It becomes especially more interesting, and one of the things that will impact what happens in 2022 is for anyone who is able to work remote or was working remote, meaning you didn't need to be physically at a property or location to do your work. In 2020 and in 2021, you took almost no vacation days. Even if you went on vacation, you didn't take a vacation day because you had a laptop, right, or a computer, and you dialed into the few meetings you needed to do, and no one took any sick days. And even the companies that would not allow, a rollover of vacation days or sick days year to year in 2020 did, and most in 2021 are. So we're going to come into 2022 with the biggest banked repository of accrued vacation days, accrued sick days than we've ever seen. Are people going to take them? Maybe. Are they going to get cashed out? Maybe. Has anyone figured out how to properly model that and forecast that? I'm not sure. I mean, they're way smarter people than I am in the forecasting of it. But how is that going to impact when certain payouts are made? And right, because it's been accrued, right? When are we paying people to take their vacation and use their sick days, but we won't have their labor actually in the physical properties?
Right.
So what are we going to do? We're going to pay overtime. We're going to pay contract labor to whom we have, right? So that's a piece that's going on. And you asked about, does business travel return? Business travel, of course, absolutely 100% returns. Does it return in exactly the same way? No. But I think we get to a fairly similar result in a slightly different way. Now, people said after 9/11, no one was going to fly on airplanes again, right? That was not true. We heard video conferencing 15, 20 years ago was going to eliminate the need to travel. We're still like, this Zoom technology is great, Ellie, and we're doing this, and I'm looking at you. But you and I were, in a bunch of different budget reviews over the last few weeks, where some people were on site, some were off site, and the technology is nice. It's not good enough, where you have to keep saying, I can't hear you. I can't see what's on the screen in the room. It's not there yet. And most of the companies, unless they've spent massively on technology, are improving, but are not doing well enough that you could have people in all different areas and be as productive as you can in an in-person meeting. What will drop off and has dropped off and will drop off is, do you need to send 10 people, once a month to like a progress update meeting for a big development or a big project? And the answer is probably not. You probably need to send the 2 or 3 most relevant, and the others can dial in by Zoom, and maybe they go once a quarter. There are certain things that you can do more efficiently with the technology, with the ability to use video and the screens. But one of the things that will do is will create less of the traditional business demand. The work from home piece will create additional rooms demand for a category. I'm not even sure what to call yet. And, the person who first started talking about this that I recall like a year and a half ago, and a year and a half ago was Ben Seidel from Real Hospitality Group. And he was like, there's a new category coming we won't know, that are the people that live or work 3-4 hours away, or, or an hour or 2-hour plane ride away from the office they need to be in one day a week. They may need to come in on Mondays, or they may need to come in on Wednesdays, or they may need to come in 1 week out of, 4 days out of the month, and that will be scheduled in advance. But they can work, somewhere in the Berkshires, or they can work somewhere in Wyoming or Montana, but then they're going to fly to San Francisco, or they're going to fly to New York, for 4 days out of the month, do their stuff. But they're going to do that every month.
Right.
So that's important. The other thing that's going to happen is anyone who works remote, anyone who works remote who wants to have advancement capabilities in the industry is going to back up and say, I need to go to every single industry conference imaginable. It's the only way to really network.
Right.
It's the only way to see other people, to network, to learn. And in some cases, if they've got a family, right, their family is going to be like, remember you used to go to these meetings and these conferences? Don't you need to go to some?
Right.
Like, wouldn't it be good for you to like get the hell away from us for a little bit? Maybe they'll say it in a more delicate way. But don't you need to be somewhere? Don't you need to go somewhere? Now,
Right.
once you got me on the work from home, if you look at all the surveys and you look at all this stuff, I mean, I joked about this almost, I think February was the last Unplugged session that we did. And I think I mentioned on it Bill Gates, when he said like, 50% of business travel is dead and done and not coming back. Well, he owns a little over 1% of Microsoft, and at the time it was worth $47 billion. And Microsoft was promoting their Teams software, right, and services. So, is 50% of business travel going to go away? No, it will drop off to some extent, but it will also free up opportunity for leisure travel. So if I'm able to, and if you and I are able to pick up and do what we need to do from almost anywhere, well, guess what? We might go somewhere, and it might be a 2-day business trip, but we're going to add 3-4 days onto it if it's a fun destination. Right. And we might dial into the handful of Zoom calls we need to, but then after that, we're going to Disney, or we're going to the ball game, or we're going to the beach, or we're going, in your case, to the distillery, right?
True.
Sounds like a good thing, right?
Yeah, absolutely. And keeping on this theme with the business traveler, how many years you think it will take for large convention travel to truly come back to 2019 levels? And kind of a side question is, why are people so focused on 2019?
So let's start with the 2019, because that's easier. We are creatures that are trained to try and compare everything we're looking at to some point of reference, some frame of reference. Comparing what we have now to 2020 or to something 5 years ago kind of doesn't work. So 2019 is, generally speaking, the cleanest, set of numbers where the industry was not in a world of hurt, not influenced by COVID or healthcare issues, starting to see the labor pressure, seeing some labor pressures because it was a tight labor market. There was a good amount of stimulus in the economy from the government and the Fed, but it's like kind of a cleaner year, right? So especially when you go through a global pandemic and a health scare, and people are scared and fearful for themselves and their families, it's like, when did things feel more normal? Things felt more normal in 2019. Let's compare to 2019. Not that is the bellwether or the absolute, but when do you get back to there? How long does it take? And you have some basis for underwriting or for analysis. I mean, one of the things that one of the things that we discuss, and you've been in this, Ellie, but we discuss with every budget review that we do with every team, is we spend a lot of time talking about tactics, and we spend a lot of time talking about competitors and what's going on, what are the strategies, and then I try to stress to everyone, the budget, the day you print it, it's obsolete. It's out of date. And the only thing I know for sure is we're going to beat the budget or we're going to underperform the budget. We're not going to hit the budget. It's just not going to, and if we do hit the budget exactly, that means someone like played with the numbers, right? You know, like we're either going to outperform or underperform. And the question is, what's going on in the local economy? What's going on in the sub-market? How can we take advantage of different things? How can we use what we know and what we have, you know, to work the best possible way and get the best possible result? So 2019 is a reasonable enough, you know, is a reasonable enough approach. And the question is, when do you get back there? And when people say, when do you get back to 2019? For what? We talked before, if you want to get back there for RevPAR, that's great. But what about the impact on all of your expenses? So your RevPAR can come back. And one of the things that we're seeing is, you know, when you see in every down cycle, is there's a disproportionate reliance on OTA business, right? Because you want to pick up as many heads and beds as possible. If you pick up $99 OTA business, but it costs you, you know, $59 to clean, sell, service your room with all the fees, right? You're making money on that. Now, you may not want the $99 business, but you may have to take it. So as you get, you know, but you're paying big commissions to Expedia or Booking or whomever else. The other thing that we've been seeing is, you know, a big growth in Airbnb and Sonder, in, you know, in the home sharing, short-term rental business. And what's happening is hotels are competing with apartments or homes or condos. And in a lot of cases, if you're, you know, if you think about who's been traveling more and the purpose of that travel, that appeals much more to leisure travel than it does to business travel. So if you're traveling with your family, you might like to have more than a 350 square foot standard hotel guest room for a family of 4 when you're going away for 5 or 6 days, especially if you're bringing your little puppy, you know, or your big dog, or your cat, or your mother-in-law, right? So if all of a sudden you can have a kitchen and a washing machine and enough space to spread out, all of a sudden there are different alternatives that the hotel industry is really competing with. And in the very beginning of the COVID environment, people were nervous about, I don't know who, I know I go to a Hilton or a Marriott and they're doing an electrostatic spraying of the room and they put the sticker on the door. You know, so it must be spotless and it must be totally disinfected. I don't know about this person's apartment or whatever. And quickly people got beyond that. They got beyond that and they said, I'd rather have this space and not be going necessarily into a crowded hotel with other people in a tight elevator. So there's a mix, and some people will go to an Airbnb or a Sonder and some will not. But those businesses are there and they're competing, which, you know, puts negative pressure on RevPAR, on both occupancy and on ADR, and puts negative pressure on your ability to actually staff things, you know, and get things done. So even the Sonders that are Sonder and Airbnb, like they are cleaning, you know, they're hiring people and paying people to clean rooms. They're hiring people and paying people to, like, you know, do repair and maintenance work, to paint, to clean, to toss out trash. So, you know, they're a direct competitor. They're very much a direct competitor on the leisure side. I think it'll take more time for them to become a direct competitor on the business side. So I probably didn't answer your question. I babbled a lot, but I didn't answer your question.
Well, the thing that I asked that I think was not spoken about was large convention travel. Sort of what, you know, when do you think that, you know, we'll get back to 2019 levels for that kind of specific business?
So that one takes the longest to come back. I think I'm going to answer something else that you didn't ask first before I get to it. So, you know, business leisure travel is moving. And again, people have record levels of savings. right? Consumers have record level of savings. As I already mentioned, they have record levels of accrued vacation days and sick days. There's a lot of pent up demand to take the family, the annual family vacation that you didn't take for a year or 2 years, and to go see grandma and to go to Disney and to go wherever it is. So leisure is, I think, going to continue to remain strong. Business travel will rebound and continue to rebound when people come back into the offices. So I mentioned before, we're in the top 10 markets, around 40%. I think you'll see business travel back to normal when you're at 75 to 80% sort of return to office. That means people are really back. Some are doing remote, some are working a little less, some are working in, suburban or, smaller satellite locations, or varying their time, but we're not there, and I think we were moving closer to there. And then the Delta, we were moving in the right direction. And then the Delta variant hit. We got through that and started to move more positively in the right direction. And the Omicron variant hit, and we moved sort of further back, and it slowed that down. It looks like Omicron, based on everything I'm reading, will spread reasonably quickly, but is not nearly as severe or nearly as impactful as Delta, or I guess the original, if you would call it the original COVID virus. So you will see people traveling more. From a business perspective, Zoom sounds great. Maybe you can get away with not going to certain places. As soon as someone loses a piece of business because their competitor or competitors got on planes and went, whether it's to an industry conference or to someone's office in any city in the country or the world, the salespeople, the rainmakers, are going to be on the next plane. They're going to say, I need to go. I got health permitting, right? Assuming they're not endangering themselves, they're going to get on the planes and go. And it is very difficult to secure new business over the phone. A lot of people want to reach out, see you, evaluate you, break bread with you. We've taken on very few new clients in the last 2 years, but we've done a lot with existing clients, right? Who we've been in rooms with, been in the trenches with, have had lunches, dinners, and I'm not hesitant to get on a plane. I'll do it carefully. I'll do it carefully and cautiously, but you're going to see more and more push for people to go and travel. You're going to see people who have hired and are supervising people in other offices that have never met them. To create and propagate a certain employee culture, you need to be moving. You need to be in front of them. Can you do it more judiciously than you did before? Yes. So then when do you get back to the convention business? Well, first of all, I went recently to the BDNY show at the Javits Center in New York, and there are a few other shows, industry trade shows going on at the same time, the HX and HDNY, I think. And at the Javits Center, their program is, you're walking around wearing a mask. I don't really want to walk a trade show floor or go to an industry conference masked up. If it's not safe enough that I can go around normally, I'm perfectly fine to Purell myself every 30 minutes, right? And even maybe spray the people or wipe down the people near me. But if I need to mask up and they're telling me I need to mask up, then it doesn't seem so safe. And why am I going there? It's uncomfortable. And is that how I'm going to network? If I can't smile at someone, if I can't, do whatever, if people are too scared to shake hands and they're elbow bumping or, they're elbow bumping, they're fist bumping, then I don't really want to go. It's not pleasant.
Right.
If I can go, and walk and do things normally and see people, I'm thrilled to. I'm absolutely thrilled to. So, and I think that's one piece. Two is, while a lot of companies and a lot of attendees at trade shows, the ones that have booths, sponsors, while they generally have pretty good budgets for all of this stuff, from the CFO's perspective, it's hey, think about how much money we save by not sending 50 or 100 people to this conference 2 years in a row. How much do we save in airfare and hotel rooms, in travel, in food, and in registrations and all that stuff. Like, of course we can't boycott the trade shows and the industry conferences. We can't do that because we need to be in front of people. We need to be in front of clients, prospective clients, trade partners, vendors. But like, it's not so bad if if we don't spend quite the same amount of money, and maybe instead of sending 100 people to that trade show in 2022, we'll send 40. And in 2023, we'll send 70, right? And then we'll see what the business dictates. And to some extent, like, those sponsorships are being determined for a big industry trade show a year plus in advance. So if it's not already in the budget for the coming year, maybe like, a handful of people need to go. Our top rainmakers need to go, or someone needs to go, or maybe we won't send our people internationally. We won't bring our people from Europe into something in New York, but the people from Boston down to Miami or down to DC can come. We don't need people flying coast to coast. So some of it is just, capital management and business management.
Right. Very, very, very interesting. Let's touch on the capital markets. So obviously these past 2 years have been very challenging for borrowers, with many hotel owners deferring debt service into 2021 and beyond, waiting for the rebound in revenue and in NOI. What are lenders doing now? Are there still restructurings going on?
So there were really kind of two types of restructurings over the last 20 months or so. I think 20 months, 22, about 20 months or so. One is real restructuring. New capital came in, whether equity or preferred equity, that shored up the situation, that pushed debt maturities out significantly. And we've seen that, and we've worked on a few of those. That, I think, is probably 20% of the restructurings that have happened. The majority of them have been put in enough equity or divert enough cash to plug the short-term holes, to figure out how to pay operating expenses, payroll, severance, ground rent, property taxes, in some cases defer debt service, maybe pay a little, but really kind of kick the can down the road a year, 2 years, even up to 3 years. And do that by, with lender approval and sometimes brand approval, rating the FF&E reserve or some other reserves. Try to push certain expenses out. Tell the brands, we know we're supposed to do such and such on our PIP and have it done by the end of 2020 or 2021. We're going to need to push that out a few years. So a lot of it was just sort of push, kick the can down the road. And lenders, for the most part, were generally okay with that, right? Existing lenders in 2020 for sure did not want to take assets back. If someone said, here are the keys, they did not want to take them back in a totally uncertain market. Even in 2021, most lenders do not want to take the keys back. The ones that would or do are typically lenders that have, bought the loan, right, for the purpose of getting to the assets. But someone who's in the traditional lending business wants to get their interest paid on a timely basis and their principal returned to them at maturity on a timely basis. That's kind of the bargain. And that's what they would like to get. So plus, in a lot of cases, they didn't want to step into the chain of title. Now, lenders and servicers, special servicers, have gotten a little bit more aggressive. Most are not very aggressive, but more aggressive, saying, you want deferrals from us, you want forbearance. We're willing to work with you, and we're willing to give you some stuff, but we need new equity coming in. It's not just us, because we don't get any of the benefit of the upside. So you put in enough, and enough is very subjective, but you put in enough, and we'll defer some of the debt service, we'll extend the maturity. So here's the problem with that, right? So for someone who has a good lender relationship and the lender's cooperating, if you had a loan that was 70% LTV in 2019 and it funded in December of 2019,
right?
And for argument's sake, let's say the value dropped a lot, but has recovered significantly. But let's say the value is a little bit less than it was in 2019. But you've also gone to your lender a few times and said, we need you to defer the interest.
Right.
Right? That you say, we want you to eliminate the interest. They say, we're not willing to do that, but we can defer it. We can give you some forbearance. And all of a sudden, if you have 6 months of accrued interest or a year of accrued interest, right, on top of what was a 70% LTV loan, it might have gone to 72 or 73% because the value dropped a little. Now add on the accrued interest.
Right.
Okay. So now you've gone from 70 to 72 or 3 to 75, 76%. And then where are the capital markets? There's a lot of capital, that can be deployed, but it's not crazy or robust debt capital markets, right? They're chasing the leisure resort assets. They're chasing leisure markets. If you're looking at a new debt financing in New York City or in San Francisco, right, or in downtown Philadelphia, not so easy. Not so easy. But if you wanna finance kind of a luxury resort in Southern Florida, yeah, you can find the capital for that. So what's going to happen is, as you come to these extended or deferred maturities, or even the initial maturities, and the borrower is then looking at the situation saying, well, now I have to refinance what's like a 76 or 77% LTV loan. And I've rated the FF&E reserves, right? And I'm going to need to do a PIP. And I've also been managing the hotel with, less than optimal staffing, right? So I either couldn't hire the right people or cut back to some extent. Now I'm going to go through this lender underwriting. I'm going to need to actually staff up the right way. I'm going to need to fund some FF&E reserves. I'm going to need to figure out how to fund the PIP that I'm doing. So all of a sudden, like, it's not so easy to refinance that 77% LTV loan without a big equity infusion. Right. So I think we're still, between 6 months and 3 years away from when you see more of the transactions that people were hoping for, that opportunistic investors were hoping for in 2020, where, someone coming in with a meaningful amount of equity might be able to restructure some of the terms, get better lender terms, but where an equity investor, an existing owner, says, you know what, I'm not putting more equity in here.
Right.
I don't see it. I'm not getting the return. Lender, what do you want to do? What do you want to do? Or I'm not willing to put more money in, but I'm willing to sort of step aside, bring in a capital partner if they're willing to bring the money, and I'll ride along with them.
Right.
So, if you go back to prior cycles, right, the hotel transactions market didn't really recover to 2006 levels, right? 2007 had a ton of LBOs, which sort of skewed the results of the hotel asset sales market. But you look at individual hotel asset sales in small portfolios, right? Two or three assets at a time, not mega portfolios. The market peaked in terms of volume and in terms of number of assets sold in 2006. It didn't get back there until 2015.
Right.
And because what happened? The markets, the operating fundamentals got better, right? Operating fundamentals got better, which is good. The debt capital markets, right? The credit markets got better. So people were able to borrow more. They were able to justify a higher valuation, right? And we're going to see some of the same, right? With every couple of months, the debt capital markets are a little bit better. There's a little bit more certainty in doing underwriting, right? And doing all our budget reviews over November and December, like we looked at it and said, it's still like a cloudy environment. It's still cloudy out there, but we have a lot more clarity than we did a year earlier in November. Right. When we were doing budgets in November of 2020 for 2021, we had no clue.
Right.
We had no clue. It was just guesswork. It was hoping the second half of the year will be better. And a lot of that is going on now as well, where the second half of 2022, people would have assumed the first half will be better. And then we got the Omicron variant and things pushed back a little bit further, not right. as devastating as the impact of Delta. But just people pushing back. Are they willing to book? Are they willing to sign up for the corporate and group events? So I think it pushes group back more than it does, business or leisure transient.
Gotcha. Okay, and continuing with the capital markets, there is a lot of liquidity out there, but investors and lenders are being very selective with respect to what opportunities they would like to pursue. Who do you see out there today deploying capital? Where are they deploying it, and why are they deploying it particularly there?
Again, you like to ask like 12 questions at once. So, there's a lot of private equity money that's been raised. There's a lot of capital that the REITs are sitting on. They went into capital preservation mode. So you're seeing for certain markets, call it trophy assets and trophy markets, anything that's marketed for sale is getting 15, 20 bids. If you go to a more unsavory market, there are not a lot of bidders. So, it's kind of interesting because you would think a lot of the smart kind of opportunistic money would figure out, go and fish up stuff really cheap in the markets that are out of favor. It's just sort of not what they do. Right. It's not how fundraising gets done in the public markets. It's not what the research analysts really want to see REIT teams do. But you're seeing REITs like Sunstone, pay big bucks to buy very high profile trophy assets in Napa, in wine country, where they're tremendous assets, right? You're seeing smart, opportunistic investors like Pebblebrook, buying up leisure-oriented resorts and assets. So, if there's a leisure component to it, if it's a leisure market, a non-union market, especially, lots and lots and lots of bids. The stuff that's coming into the much tougher to underwrite markets are, in some cases, foreign capital who will scoop up things at very low prices. Just opportunistic foreign investors like, oh, I could pay a few $1,000,000 for this, and I understand there's a ground lease and a difficult union contract and the asset's not in good shape, but how can I not own this if it only costs a few $1,000,000, right? How can I not own it?
Right.
So, a lot depends on where the source of their capital is coming from and what they're doing. And we see the lender community generally follows along with that, right? They want to lend against something that they know the collateral is good, that they can get taken out on the loan, the implied LTV is good, and generally that there's a really good sponsor.
Right.
So do asset sale prices make sense? It's kind of tough to tell if they make sense. In many cases, if you're a long-term holder, if you're a 10-year holder, you can make a lot of sense out of certain things, where if you're a 3 to 5 year investor, you may not, right? Because how quick do we come all the way through this period, right? And you started off by asking, about RevPAR projections, or maybe maybe you didn't ask and I just talked about it. But like, as a practical matter, right, the industry prognosticators are saying, we're saying we'll get back by 2024, and then they tightened it to 2023. Now, that's for the US as a whole, right? They'll continue to tell you the big convention properties and whatnot, might take till 2025. So much of it, is a function of the politics and the fear factor. Right. So if we have different masking requirements and different indoor requirements in different cities, right, that has an impact on who's visiting those cities and the perceived sense of safety in those cities, and just the messaging that it sends. So who is doing, who's coming to all these markets? If you look at the public projections for the REITs, right, the public hotel REITs, and you look at roughly where they are, the market generally expects that in 2022, their EBITDA will be at 76% of 2019 levels. And in 2023, they'll be at 91%. So by the end of 2023, their EBITDA will not be all the way back, but their RevPAR will, right? Meaning, meaning they have negative pressure on their margins, right? Which we've talked about, which is labor. Then if you look at the hotel C corps, right, by the end of 2022, right, the research estimates, right, assume they'll be back at 98% of 2019 EBITDA. And by 2023, they'll be at 109% of 2019 EBITDA. So they're recovering much better, partly because they continue to have growth in franchise fee income and management fee income, and they've gotten more efficient in terms of their labor model.
Right.
Right. So if they have less corporate staff and they're able to use technology more, they're able to do more with less, and they were able to retire certain people, right, and give people battlefield promotions, right, to do more work for equal or even less pay, right, the EBITDA margins go up. So, is that realistic? Yeah, it's realistic. So, if you think about the larger institutional type assets that a lot of the public REITs hold, right, some of them are in large markets, some of them are in major kind of CBDs, right, where it's going to take longer to get back to the same place, right? If the office occupancy, doesn't get all the way back to where it needs to be, and people are nervous about sending to conventions, well, you see more leisure traveler, right? And they might even pay a higher ADR, but the leisure traveler is not using the meeting space in the hotel.
Right.
So there's less banqueting business, and that leisure traveler is probably going out of the hotel more than eating in the hotel restaurant or the hotel bar. All things, if it's a standard kind of hotel, if it's a boutique hotel with a top-notch restaurant, that might be a different story.
Right. All right. And touching back on something that you spoke about earlier, where immediately after finishing a budget, it's already out of date. So in this climate, in this scenario, with such limited visibility today, how are deals actually getting underwritten?
Delicately. No, you have to have a. If you don't have a sense, and this is why when you asked about the 2019 number, you don't have a sense of when you get back to normalcy, you can't really underwrite anything, right? So you have to have some point of view and then run some sensitivities on it. Now, one of the saving graces, the flip side of all the headache that we have, is 7.7 or almost $8 trillion worth of stimulus into the markets means people are spending money. That means they go to hotels, they go to restaurants and hotels, they go to spas and hotels. They're spending money. They have money to spend, and a lot of it has not been spent yet. So that's piece one. Piece two is if you think about the challenges with buying or financing an existing hotel, multiply that many times over in the complexity and difficulty in getting a construction loan for a new hotel, for underwriting, even longer into the future, kind of how a new hotel is going to come, and then overlay what's going on in the global supply chain, right? What's going on with the cost of lumber? What's going on with the cost of steel, the cost of glass? Can you actually buy your FF&E and case goods, right? And have them come at the right place? How can you lock into a general contractor and a GMP contract with a general contractor when he has no idea what he can get in terms of subcontractors and the related labor? So contractors are bidding everything high, like very wide. You want me to do this? I can do it, but it's going to cost this, because they can't manage the risk the same way they did before. And then if they can't really manage effectively what's coming on what boat and what truck and when, right, it's less efficient. So one of the benefits that the hotel industry has for the next few years is the ability to, not have as much new supply come online. So even though a lot of things are in planning, if something is not already broken ground and fully financed, the chances that it starts and gets finished on time is low.
Right.
It doesn't mean we will see no new supply, but as a practical matter, it's much more difficult to get a construction loan, to underwrite a deal, to get it done and get it moving. In some cases, it's just been difficult to get through, a planning board process, because the boards haven't been meeting, or they're meeting via Zoom and someone can't figure out how their camera works, or they didn't get the materials to look at. So things are sort of convoluted. They're just taking longer and longer. And if you're an owner of existing hotels and there's less new supply coming, that's a good thing for you.
Right. Very interesting. Switching gears to the public markets, you touched on it a little bit. You said that research is currently expecting 2022 EBITDA to be 76% of 2019. So obviously there's a lot of uncertainty. How are the public hotel companies today being valued, and what are investors looking for in making an investment into a public hotel REIT or a public hotel company?
So previously, right, before you got to November, December of last year with the Pfizer and Moderna vaccines announced, everyone was in absolute cash hoarding mode, right? Preserve every dollar of cash you can, defer every expense you can. And both public REITs and public C Corps, the hotel REITs and C Corps, got walloped in terms of their equity prices. They started to come back. When you saw some of the larger companies issue bonds. And all of a sudden you said, oh, they can issue bonds at 5% interest when it might have been 2.5% or 3%, a year earlier, but they can actually access the public credit markets, and they can issue equity if they need to. And they, for the most part, have credit facilities, lines of credit with banks or consortia of banks, and they were able to draw on their lines. So they were sitting on a whole bunch of cash, and they were talking about cash burn rates, which you really didn't hear hotel REITs talk about cash burn rates in the past. You heard .com companies talk about that. You talked about a little bit right after 9/11, and then a little bit in the end of 2008, beginning of 2009. How much cash are we running through every month? But broadly speaking, you didn't see that. One of the things that's important to focus on is the hotel REITs are about 53% debt to enterprise value, right, in terms of their debt, and that varies kind of widely. There are a few that are way higher and a bunch that are lower. So they're not over levered, as a generalization. The hotel C Corps, right, the Marriotts and Hiltons and IHGs of the world, on average, including Hyatt, right, on average are about 18% debt to EBITDA. So they have very little debt, right? They're not really worried about, how are we going to make the debt service? How are we going to refinance this? Obviously, they need to refinance pieces of their debt as it comes due. But one of the things when you think about the public vehicles is, after the initial shock in March and April and May of 2020, people started to figure out the majority of the public players are likely to be survivors. And they have strong management teams, they have a lot of resources, and they should be net acquirers, right? Maybe not during 2020, but over the next several years, they should have the resources to acquire assets, right, from people in situations like we talked about before. It may be a perfectly good asset, but it's over levered. And someone's not putting in more money, and to do the PIP and to de-lever in order to refinance. So you've started to see the REITs earlier this year step up and buy, start getting into buying mode. And I don't think they're paying crazy prices, but in some cases they're paying pretty full prices, knowing that if they're, a 10-year holder, a 20-year holder, long-term holder, their cost of capital is way less than the opportunity funds.
Right.
And if the recovery takes 12 or 24 months longer than they projected, right, it's okay. They're not coming up against the end of their holding period where they need to turn around and sell, while they don't want it to take an extra 12 or 24 months to get to a recovery. It's okay if it does.
Right.
It's okay. They can afford to carry it and hold it. And if that gets factored into the price and into the overall strategy, right, that makes sense. The other thing that's being factored in right now is everyone is assuming, the REIT management teams and the public teams are talking about it. So everyone is assuming, and it may be right, we'll know in a few years, is there are a whole lot of costs that have been stripped out of the operating models, some of which may not come back in, right? So if you know, for a limited service hotel or even a full service DoubleTree hotel, if all of a sudden you're not doing room service every day, housekeeping every day, if you're not doing housekeeping every day, but doing it every 3 days or doing it only on demand, right? You might be saving on a quarter of your labor, right? You might be saving meaningfully on, you know, it depends also on length of stay. You might be saving meaningfully on your housekeeping expense. Now, some of that is going to factor into your revenue management and how you think about length of stay, right? You do a lot better if you have someone staying 3 nights instead of 2 nights, right? You know, versus 2 nights and you have to clean the room, right, to check someone else in versus 3 nights and you don't, right? If that can be meaningful savings. So working on the free breakfasts and how, you know, how you can shrink the size of that or do things. Some of those things will stay, some will not, right? As people are paying more and, you know, the brand standards get rolled back out, but there's an assumption of a couple of 100 basis points and in some cases more of margin efficiency built into the recovery, which may or may not happen, right? I think most have not gotten granular enough in terms of real labor costs and where they're going to be and how we're competing with other industries, and where we're already at a very low unemployment rate and there are more and more pressures on people. If we go back to 2019 occupancies, right, and push occupancy way up from where it is today, who's cleaning the rooms?
Right.
Who's serving the dinners? Who's working at the bar? Who's tossing the trash, right? We need to find the labor from somewhere.
Right. Yeah, my last question on this particular topic is, since 2020, stock prices have obviously come back tremendously for hotel companies, for REITs, more for the hotel companies than they have for the REITs. Do you, in your opinion, do you think the markets are acting right now in a rational manner?
Yes and no. So it seems irrational, but when you say the markets, right, the markets are an aggregate, right? An aggregate of lots of different investors, buyers, sellers of all shapes and sizes. Now, if you think about the returns that an investor might get by deploying money into U.S. government securities, right? If they buy, you know, 10-year treasuries and, you know, get a 1.5% or 1.6% yield, you know, and they have certain obligations they have to pay, right? Say they're a pension fund and they need to pay out pension money, right, on a regular basis. They can't make money. They can't make the returns they need buying simple treasuries. Then you go to corporates, right? So can they make enough return buying bonds yielding 3, 4, 5%, maybe even 6%? Can they make it? Where can they make the return they need to in the equities markets, right? And the equity markets overall are being fueled by a lot of money going into mutual funds, a lot of money going into hedge funds, and then they in turn need to put the money out. So some of it is driven by, you know, overall kind of market momentum. Some of it is driven by the hope and optimism that the hotel industry brings, like it got beat up really bad. Like, of course, it should get back to where it is and with smart teams and more efficiency built in. So there's some level of rationality to it. But what most people, you know, what happens in sort of every upmarket that hotel industry investors forget is the hotels are an operating service business sitting on a piece of real estate. It's not a real estate investment. It's an operating service business investment and a real estate investment. And as a result, it's much more volatile. It's much more risky. And the risk premium narrows, right? As people are bidding up the prices of public stocks and equities. And we basically are living in a world where, you know, where people assume everything just must go up. Right. And, you know, I think right now, you know, we're talking about the future and good efficiencies and whatever, and where you'll see the hotel stocks go is partly where the overall market goes. And partly if they're able to achieve the EBITDA results and the margins, they'll continue to trade pretty well. And if they don't, you know, they'll trade off and, you know, and get walloped pretty good. The other piece that we think about when we look at the public REITs is, even though they're long-term investment holders, right? 74% of the public hotel REIT debt is fixed rate, right? So when it does get redone, right, at maturity, it's going to resize to whatever the current rates are, which are probably going to be higher in the next few years than they were in the last few years. And they have an average term of 3.3 years. So even though they're long-term holders, long-term investors in assets, a lot of them are not using mortgage debt on all their properties, and they're using corporate facilities that are shorter term, some short-term term debt or unsecured notes. And then when you look at the C Corps, they're 87% fixed with a 5.5-year term.
Right.
So they're a little bit longer term. But what's going to happen is these are all going to roll on a regular basis, and you're going to see debt prices go higher, right? The expectation right now, based on just about every economist and based on signaling from the Fed, is that there will be a whole series of interest rate hikes in order to tame or curb inflation, and that the 10-year Treasury, which is now at about, now at like 1.6 or so, 1.5, 1.6, is going to be closer to 2.2, 2.3, 2.4, 2.5 by the end of 2022. So it doesn't sound like a lot, 100 basis points higher. But if you think about someone in the residential market, if you have a mortgage on your home,
right?
If you have a mortgage on your home and rates go up, 40, interest rates go up 40%. If you're variable, it's a problem. And if you, are otherwise going to buy something going forward, it's going to cost way more in terms of debt service on a percentage basis than otherwise.
Right. Thank you. All right. Our last question, or my last question before we go to the Q&A and see if there are any good questions there, is prediction time. There's still a lot of uncertainty. Obviously, as we've spoken about, what predictions do you have for 2022 and 2023? I mean, I could get more granular, especially, as it relates to the U.S. hotel performance, supply chain.
I think it's still going to be very difficult to figure out how to get new construction loans and build things. I think the supply chain dynamics will get a little bit better. They'll get somewhat better, but certain things will still be very difficult. I think labor is going to be the biggest and most labor and inflation will be the biggest, most talked about issues out there. I think we're going to get into sort of a rocky space as we come into the second half of 2022 with the midterm elections for Congress and Senate, and you'll see a lot of vitriol and a lot of mudslinging, with each party blaming the other over who did what and how and why. And my working assumption, just based on history and current polling, is that the Republicans will retake the House and maybe the Senate. But as a result, you'll end up with a more toned down presidency and things kind of running through the Congress versus what you see now with kind of a one party system. I will tell you, 2022 will be very bad for me if I don't talk on this webinar about social media and the JF social media business that we've created through our asset management business. So maybe we'll hear for one more minute from Ryan, our intern, about social media in the year to come.
Hi, it's Ryan, the intern here again. Some of you don't really appreciate it, but if you don't have a very strong and thoughtful social media plan, you are missing out. Social media is becoming more important every day and can be used to make money. By the way, if you need a model, spokesperson, or influencer, I could be available, especially any resort locations with a beach or a pool.
So we've been very focused on social media, right, as a part of our overall business in terms of increasing social catering, in terms of increasing demand for room nights, promoting, et cetera, where there's kind of a crowded landscape, and the more you can get, the more you can divert away from the OTAs, the better. And with that, Ellie, you want to get into the Q&A?
Sure. All right,
Got a
let's
whole
ask
bunch of
this.
questions.
Sure. This first question is from Greg Miller. Given the relatively superior performance of select service hotels since the pandemic, a few teams have suggested that cap rate spreads between full service and select service assets may shrink by 100 basis points. What do you feel about the, how select service hotels and full service hotels are going to be valued, in the next year or two?
So much easier to debt finance the select service, especially extended stay hotels, because they don't have the volatility of the food and beverage business, the banqueting and catering business. It's a rooms business, and they generally don't go as high in occupancy. So in a up market, they won't rise as much. In a down market, they won't fall as much. And in a lot of cases, we've seen, business has continued, right? Contract business has continued. Interstate truckers have, trucking has continued. So will you see this spread? It kind of depends, right? It's really a function of which markets they're in and how you can debt finance them. So I think a lot of the cap rates will really be driven based on how the debt financing works.
Gotcha. Okay, another question regarding FF&E reserves. Most people underwrite deals using a 4 or 5% FF&E reserve. Do you think that this is low based on, kind of what you're seeing and the analysis that we've done together?
So the answer is 4 to 5% is perfectly fine if that's used for FF&E. When you're using, and FF&E stands for furniture, fixtures, and equipment. So if you're using those reserve dollars for roofs and for technology upgrades and for various things that are not really part of FF&E, then you won't have a big enough reserve, right? We think 4 to 5% is probably fine for FF&E. But when you add in all the other things, that's brand standards, that's systems, technology, et cetera. As I said before, you're going to get up over 9% of revenue.
Gotcha. A question from Doug Rigoni. Says, Jonathan, can you talk more about organized labor is doing across the country? Maybe more about what the unions are doing in New York City.
So we can do an hour and a half webinar on that. And basically, Joe Biden is the most pro-union president we've ever had and probably ever will have. When he was in his first day in office, he made major changes at the NLRB. The things that are going on in various cities like New York City, in terms of what the union has done through multiple arbitrations and then pushing the city council to restrict new hotel development is very heavy and very difficult. But one of the things that's happening at the NLRB is they're making it substantially easier to organize, to add to bargaining units, to have micro bargaining units. And if you don't have a real labor strategy, you should. And if you want to talk, anyone who wants to talk offline about that, happy to talk and happy to refer some very good labor counsel. And we've worked with a number of different firms that are really very good in different areas in the country in terms of what to do if you're trying to, stay non-union, as well as if you are union and want to figure out sort of the right strategies. But it's, one of the things back, Ellie, on the public markets discussion is one of the things people should be doing is looking and saying, okay, of the hotels that this REIT owns, how many of them are union? How many of them are big box? How many of them are ground leased, right? How do we really get our arms around this? Because it is very difficult to get the EBITDA recovery that you want or need if you have a union contract covering a lot of your employees.
Okay. Got a question. How are lenders and servicers dealing in Q4 with forbearance extensions?
It's very similar to in the past, right? They're seeing a better market. They're seeing the ability to actually trade out of their loans if they need to, and they're a little less worried about taking some action. So if borrowers are willing to put fresh equity in, they're willing to do more forbearance and work with them. If borrowers are not, they're taking a much more aggressive stance, much more aggressive than we saw a year ago.
Okay, what do you think? What do you think the FTE summaries look like? January 1st, 2022 compared to January 1st, 2021 compared to January 1st, 2020. Basically, how many positions need to be rehired that you think maybe people aren't paying attention to, and maybe those January 1st, 2022 FTE counts will increase substantially if things actually do get better?
So it's a great question, and it's all across the board. And I think there are a lot of positions that are open not by choice. We're just having difficulty in hotels all over the place filling them. So it shows up as some cost savings in the interim. People are also, many operators are budgeting low, thinking that if the market really recovers quicker than they expect, they'll be able to go hire more people. But the hiring process is difficult. I mean, as a hotel industry, we have almost higher turnover in staff, higher staff turnover than any other industry. The only other one is restaurant industry. And there's no line item in the P&L that shows up as like lost productivity, right? From all this employee churn. If it did, people would be really alarmed, and we'd be like, oh, we should just pay the people more. We should hug them every day. Not to get a sexual harassment claim, but we should virtually or sort of like, in theory, hug them every day and thank them for their service and thank them for being part of our team, because the cost to recruit, rehire, retrain, replace, get people up to speed is so much higher than most people assume.
Okay, we got 3 minutes left. I think we have hopefully time for one more question. Is that okay?
Just bang it out. We can do two
more.
All
right. All right. So we have a question about the recent purchases by Host, Sunstone, and Pebblebrook. Obviously, they've been paying very high price per key for leisure assets. So the question is, what is the exit strategy when you're purchasing an asset for $1 million a key?
So if you are Host, which has been a publicly traded vehicle for 20 plus years, you don't have an exit strategy. You're buying real estate that you think is, very strong. Same thing. The Sunstone mantra is long-term relevant real estate. So they're buying assets that they don't really need to sell, don't intend to sell. Now, you might always, if someone comes along, if you bought something for $2 million a key and someone came along the next day and offered you $3 million a key, you might sell it. But they don't need to, right? They're going to look to, maximize the performance, and they're looking at it also saying, no one's building a comparable property to this anytime soon, right? It would cost more than that to build what we just bought. So we're going to sit there and we're going to focus on maximizing average daily rate, maximizing the performance, and seeing what other synergies there are. Is there anything else to create? Is there any residential opportunity? Is there something else to do? But their cost of capital is a lot cheaper than that of a real estate opportunity fund. Their ability to finance it is substantially better. And their hold period allows for, fluctuations in the market.
Okay. In terms of supply, you heard a lot about new supply coming online between 2015, 2019 in major markets, New York, Nashville, Austin. We haven't heard as much about new supply. What is your thinking on future of new supply, especially as it relates to these major markets?
I think there will be a lot less new supply over the next few years. It's just really difficult to do the underwriting. It's really difficult to figure out how to get a general contractor and locked in pricing. So you'll see a lot continue to be in pre-planning, but you will not see that much new supply. And that is also sort of, a very nice tailwind for the industry, right? Every time you have increased demand, right, and limits on supply, that's a good thing. Several years forward, supply will start to come back, but the next few years, for the most part, we'll see new supply growth slow down quite a bit in almost every market in the country. And with that, Ellie, I think we're out of the time. So thanks for asking me 14-part questions, and thanks for being kind as I just rambled on and babbled about different things. For everyone who's on, the replay should be available, if not later today, by tomorrow morning. If you'd like to chat about any of these topics offline, reach out to Ellie, reach out to me. And for anyone we don't speak to before the end of the year, have a wonderful, healthy, happy, productive 2022. Thank you for listening.
Thanks, guys.